Smart investors understand the importance of choosing the right assets to grow and protect their wealth. In the world of investing, two primary vehicles dominate the landscape: bonds and stocks. While both offer unique benefits, they also come with varying risks and returns, making it essential to understand the differences before deciding which fits your financial goals. Today, we'll dive deep into comparing bonds and stocks, exploring everything from risk factors to return potentials, and how to choose the right investment based on your personal financial situation. By the end, you'll have a clear understanding of which asset class is better for you, bonds or stocks. Section 1. What are stocks? To begin, let's first look at stocks, often referred to as equities. When you buy a stock, you're purchasing a piece of ownership in a company. This gives you a stake in its profits and future growth. 1.1 Types of stocks. There are several categories of stocks, each with its own set of characteristics. 1. Common stocks. These are the most frequently traded. 1. As a shareholder, you can benefit from dividends and capital appreciation. 2. Preferred stocks. Offer fixed dividends and take priority over common stocks in the event of bankruptcy. 3. Growth stocks. These stocks belong to companies that are expected to grow at a faster rate than the overall market, but typically do not pay dividends. 4. Dividend stocks. These are stocks of companies that regularly pay dividends, making them popular among income-focused investors. 1.2 How stocks generate returns. Stocks generate returns in two main ways. 1. Capital gains, when the value of your stock increases over time, and you sell it for a profit. 2. Dividends. Companies pay a portion of their profits back to shareholders in the form of dividends. The potential for capital gains and dividends makes stocks appealing to investors, but their price volatility is a risk to be aware of. 1.3 Stock market volatility. Stock prices fluctuate based on a variety of factors including company performance, broader economic conditions, and investor sentiment. This volatility presents both risks and opportunities. Section 2. What are bonds? Bonds, on the other hand, represent loans made to governments, corporations, or other entities. When you invest in bonds, you are essentially lending your money to the issuer in exchange for periodic interest payments and the return of your principal upon maturity. 2.1 Types of bonds. Bonds come in various forms, each catering to different types of investors. 1. Government bonds, issued by national governments, such as U.S. Treasury bonds, which are generally considered low risk. 2. Corporate bonds, issued by companies and offer higher yields but carry higher risk. 3. Municipal bonds, issued by local governments or municipalities and may offer tax advantages. 4. High-yield bonds, also known as junk bonds, these offer higher interest rates due to the increased risk of default. 2.2 How bonds generate returns. Bonds provide income through interest payments, also known as coupon payments. Unlike stocks, the income is fixed, making bonds a safer option for those seeking stable returns. 2.3 Bond market behavior. Bond prices fluctuate based on interest rates and economic conditions. Generally, when interest rates rise, bond prices fall, and vice versa. Section 3. Risk and return. Bonds versus stocks. One of the most crucial factors in deciding between bonds and stocks is understanding their risk and return profiles. Let's compare. 3.1 Risk in stocks. Stocks offer the potential for higher returns, but with this comes increased risk. Here's what you should consider. 1. Market risk. Stock prices are influenced by market conditions, such as changes in economic policy or geopolitical events. 2. Company-specific risk. Individual stock prices can fluctuate based on the company's performance. 3. Volatility. Stock markets are often more volatile than bond markets, meaning prices can swing dramatically. 3.2 Risk in bonds. Bonds are generally considered safer than stocks, but they are not without risk. 1. Interest rate risk. When interest rates rise, bond prices tend to fall, impacting their market value. 2. Credit risk. The issuer could default, meaning you won't get your expected interest payments or principal back. 3. Inflation risk. Bonds with fixed payments may lose value in times of high inflation because the fixed interest income doesn't adjust. 3.3 Returns. Bonds versus stocks. Historically, stocks have outperformed bonds over the long term due to their higher potential for growth. Bonds, while more stable, generally offer lower returns. Section 4. Stock market versus bond market. Key differences beyond risk and return. It's important to understand how the stock and bond markets operate. 4.1 Ownership versus debt. 1. Stocks represent ownership in a company. 1. When you buy stocks, you become a shareholder and may benefit from both dividends and capital appreciation. 2. Bonds represent a loan to the issuer. 2. You are not a part owner of the entity. Instead, you receive interest payments as compensation for lending your money. 4.2 Liquidity. 1. Stocks. Stock markets are highly liquid, with most stocks being bought and sold quickly on major exchanges. 2. Bonds. Some bonds, especially those issued by large entities, are liquid, but others, like municipal bonds, may be harder to sell without affecting the price. 4.3 Pricing and valuation. 1. Stocks. Prices are influenced by market sentiment, company earnings, and economic conditions. 2. Bonds. Bond prices are influenced primarily by interest rates, credit quality, and the bond's maturity. Section 5. Diversification. The power of combining bonds and stocks. A popular strategy in investing is diversification, or spreading your money across different assets to reduce risk. 5.1 Balanced portfolios. Balanced portfolios contain both stocks and bonds, allowing investors to enjoy the potential growth of stocks while mitigating risk through bond exposure. Here are common asset allocation strategies. 1. 60/40 portfolio. A classic portfolio with 60% stocks and 40% bonds. 1. This allocation is designed to balance growth and stability. 2. Aggressive growth. More stocks, fewer bonds. 2. Typically for younger investors with longer time horizons. 3. Conservative. More bonds, fewer stocks. 3. Suitable for retirees or risk-averse investors. 5.2 Portfolio rebalancing. As markets fluctuate, the value of your stocks and bonds may change, altering your asset allocation. Rebalancing involves adjusting your portfolio to return to its original allocation, ensuring your risk tolerance remains aligned with your goals. Section 6. Historical performance. Stocks versus bonds. 6.1 Stock market performance. Historically, the stock market has delivered higher returns than bonds over long periods. However, it's also more volatile, experiencing larger price swings. 6.2 Bond market performance. Bonds have been more stable than stocks, particularly during market downturns. During times of economic crisis, bond markets tend to outperform stocks, as investors flee to safer assets. 6.3 Past crises. Looking back at financial crises, such as the 2008 global financial crisis, or the dot-com bubble, we can see how stocks and bonds behaved differently. During these periods, bonds typically held their value, while stocks took years to recover. Section 7. Choosing the right investment, bonds or stocks. How do you choose between bonds and stocks? It depends on your personal circumstances. 7.1 Time horizon. 1. Long-term investors. Stocks may be more appropriate for long-term growth. 2. Short-term investors. Bonds could be better for preserving capital over shorter periods. 7.2 Financial goals. 1. Capital growth. Stocks are ideal for investors seeking growth. 2. Income. Bonds provide steady income, suitable for those who prioritize cash flow. 7.3 Risk tolerance. Your tolerance for risk will largely determine whether you lean towards stocks or bonds. Those comfortable with higher risk may prefer stocks, while risk-averse investors may lean towards bonds. Conclusion. In the debate of bonds versus stocks, there is no clear winner. Both asset classes serve different purposes within an investment portfolio. Stocks offer higher growth potential but come with more volatility, while bonds provide stability and income. For many investors, the best approach is to combine both stocks and bonds, balancing the potential for growth with the need for security. By considering your financial goals, risk tolerance, and investment horizon, you can tailor a strategy that works best for you. Thank you for watching. If this video helped clarify the stock versus bond debate, please like, subscribe, and hit the bell for more insights on smart investing and building wealth. Let us know in the comments, are you more of a stock investor or a bond investor?